Welcome back. Today we're digging into a pretty serious institutional strategy report. And its main argument? That all this euphoria we're seeing in the market? Well, it might just be a mirage. The analysis suggests that while everything looks fantastic on the surface, the whole system is actually running on fumes and hiding some major risks.
So here's how we're going to break this down. First, we'll look at the priced for perfection market that you're seeing in all the headlines. Then, we're going to peel back the layers to see who's really driving this thing and what kind of fuel it's using. After that, we'll get into a disappearing safety net, explore two very different paths for the future, and then wrap up with the report's, well, pretty stark final verdict.
All right, first things first, let's just set the scene. I mean, from the outside looking in, the market looks completely unstoppable, right? It's hitting these highs that, honestly, a year ago, most people would have said were impossible.
On April 15, 2026, the S&P 500, the big benchmark for the entire U.S. stock market, closed at a new, absolutely stunning all-time high.
And look, it wasn't just the S&P. The tech-heavy NASDAQ also notched its 11th straight day of gains. That's a winning streak we haven't seen since the absolute peak of the dot-com boom way back in 1999. And that little historical parallel is something this report finds very, very telling.
So yeah, everyone's popping the champagne, but this report basically hits the brakes and asks a critical question. It argues the market is priced for perfection as if nothing could possibly go wrong. But the reality? Well, it's anything but. Let's dig into the first reason why. Okay, so the first major crack in this beautiful story appears when you start asking a really simple question. Who is actually driving this incredible performance? Is this a broad, healthy rise across the entire market where everybody's winning? And this chart, wow, it lays the problem bare, doesn't it? The rally isn't broad-based at all. You've got this tiny handful of mega-cap tech stocks, the Magnificent Seven, doing all of the heavy lifting. Meanwhile, the other 493 stocks in the index, they're essentially going nowhere. And this right here really drives the point home. Get this, on the very same day the index hit a record high, more stocks went down than went up. That's a classic sign of poor market health, what analysts call bad market breath. It's like an army claiming victory while most of its soldiers are actually retreating.
So the key takeaway here is this. The report frames this not as a sign of broad economic strength, but as a fragile and dangerously top-heavy market. It's a concentration of risk that, as history has shown us, can unwind very, very quickly.
So if it's not a broad, healthy rally based on strong company earnings across the board, then what in the world is pushing these select few stocks to such astronomical heights? According to this report, the answer isn't in the usual places. It's deep in the market's technical plumbing. The report argues the market's engine isn't running on strong fundamentals. Instead, it's being powered by a technical phenomenon called a gamma squeeze. The best way to think about it is like a snowball rolling downhill. A huge surge in options trading forces dealers to buy the stock to hedge their positions. That buying pushes the price up, which then forces them to buy even more. It becomes a self-reinforcing loop driven purely by mechanics, not by value.
And this shows the key difference perfectly. A fundamental rally is sustainable, like a well-built engine. A technical squeeze, though, is just a sugar rush. It's incredibly powerful for a moment, but it's unstable and it's prone to a crash. And this report is adamant that we are experiencing the sugar rush.
Now we get to the absolute core of this report's warning. Because while everyone is watching the stock market ticker, an invisible risk has been growing in the very foundations of the financial system.
So there's something called the Fed's reverse repo facility. You can just think of it as the financial system's emergency cash reserve. It's that critical buffer you need for times of stress. And just a year ago, that buffer was robust, holding right around $1 trillion.
Today, well, that buffer has essentially vanished. It has plunged from $1 trillion to just 223 million times million. And no, that is not a typo. That is a drop of over 99.9%. The system's safety net is gone.
So what does this mean? It means this has created a massive vulnerability. The system has lost its primary shock absorber. That analogy of a petty cash drawer is perfect. The entire banking system's emergency fund is empty, so there's no cushion left to soften any unexpected financial blows.
And to make matters even worse, on the exact day this report was written, April 15th, tax day, an estimated $500 billion was being pulled out of the financial system for tax payments. So you have this massive liquidity drain hitting a system that has no buffer left.
So what happens next? You've got a top-heavy market and a depleted safety net. The analysis lays out two potential paths forward, but, and this is key, it assigns them very, very different probabilities.
The base case, with a 60% probability, is for a significant market downturn. For that scenario, the report advises a defensive strategy. That means reducing exposure to those high-flying, overvalued tech stocks and rotating into safer, more defensive sectors like healthcare and consumer staples.
And then there's the tail risk. The report assigns a 10% chance of a black swan event, a sudden seizure in the financial system's plumbing, what's known as the repo market. It's the kind of thing the market seems to be completely ignoring, but it's an event that could be triggered by even a small shock now that the liquidity buffer is all gone.
All right, let's bring all these pieces together for the report's final, unvarnished verdict on the state of the market.
The final verdict is unequivocally bearish. The report concludes that the headline strength we see in the major indices is just an illusion. It's a mirage built on fragile technicals, while the underlying fundamental foundation of liquidity is severely damaged.
So what's the one thing to watch now? The report singles out the upcoming earnings from TSMC, the world's most critical semiconductor company. Their results are going to be the ultimate reality check for the whole AI hype that's fueled this entire rally. Any weak guidance from them could be the pin that finally pops this bubble.
And that leaves us with this final, powerful thought from the report. In a market that expects absolutely nothing to go wrong, the smallest stumble can cause an avalanche. The analysis concludes that while the party is still going, it might be a prudent time to start looking for the exits.